Okay, so I'm gonna try a slightly different format here, just to walk through different ways I look at different businesses. And so I think I'd be remiss if I didn't credit Horizon Kinetics here as their original research is what originally got me interested in WaterBridge. Um, and for those of you who have not heard of it before, WaterBridge is a um, infrastructure company that provides water takeaway services for oil and gas producers. So every time oil is drilled in the Permian Basin, water comes up with the oil, typically at a ratio of 4 barrels to 5 barrels to 6 barrels of water to 1 barrel of oil. So right now you could look at it as a sort of midstream oil infrastructure company, which is fairly boring. But hopefully by the end of this video, you can see what might be hiding underneath that initial look. And so there's a few different ways that I start to look at a business just to get my arms around it. So first and foremost, I want to take a look at the balance sheet. Like, what am I actually underwriting? Are there existing assets? What's the debt level? What actually am I buying today? And that's super important. And so um, first, what we'll do, and this is typically what I do, is I'll just take a quick scan of the existing assets, the amount of cash they have, about $50 million on the balance sheet. Um, Obviously, this is an infrastructure company. There's going to be a lot of PP&E, so about 2.3, $2.4 billion worth of property, plant, and equipment. So that's everything from the pipes that are transporting the water to the well pads, etc. This company just went public, and so there are um, a couple of different liabilities, like the tax receivable agreement liability, which will obviously get paid down over time. But the very minimum, obviously, there's $1.4 billion of long term debt as well. The very minimum, really, this is an asset heavy company that's really in its infancy. And so there is some debt, there's some IPO costs, there's a private equity sponsor hangover. So a couple things to consider as we go through, but that's sort of a good sense of what we're looking at. So next thing I want to look at, because this is an infrastructure company, asset heavy, I want to take a look at how much money they're making. So not really just on the income statement from a net income standpoint, but I want to look at how much cash they're generating. So a pretty simple trick I like to do. Obviously, on first blush, you're seeing, okay, last quarter there's $200 million of revenue and about $9 million of earnings. Seems like a pretty low margin business if you look at it from this standpoint. If you look a little bit closer, what you'll be able to see is there's a lot of depreciation and amortization costs. And so I want to add that back in to see how much cash they're actually generating. So if I take this $200 million number, I want to take it and I want to go to the cash flow statement. And I want to add back in this depreciation figure, which we have here. And what we see here is it's going to be between, around $95 million generated from just that $200 million of top line revenue. And so that's pretty good. It's a pretty good margin. Obviously, a lot of it is going to the initial build out of this pipeline network and capital expenditures. And so we expect to see this for the time being. But that's pretty good at the top line. Once this starts to come down, we'll start to see something sort of interesting. So those are the first few things I'm looking at, right? Balance sheet, free cash flow, where the earnings costs. I like the economic profile right now, but then, this is all fine and well. What are the durability of the earnings, right? So how durable and how much can I rely on those earnings going forward? This has everything to do with competition, contract length. And what we can see here is a lot of these contracts that WaterBridge has with these oil and gas producers are really long contracts, right? Double digit and over a decade typically in terms of contract tenor. And this is really important in terms of growing the business and having durable earnings you can rely on. So I really like to see that. Okay, pretty straightforward. Next thing I want to think about is the competition scarcity of assets. So I'm fairly sure, I don't want to misquote anyone here, but I'm pretty sure this is the largest produced water network, at least in the Permian Basin and even um, nationally in the US. Water is one of the most important pieces in the data center build out, as most of the power generation, whether it be gas, nuclear, what have you, at the base load, is going to be thermal power. And so water, not only from a power generation standpoint, but from a data center cooling standpoint, will be increasingly important. And you could say even more generally, water is the scarcest asset that humans have. Okay, so just that alone, I'm actually quite comfortable and like this concept generally. And so I'm going to give that a check as well. Next, I like to think about what do I have to believe to be true for this to be a good investment for me? What I have to believe is that we're going to have to balance the global energy markets in the Permian Basin. So we're going to have to keep drilling for oil. And the more we drill for oil in the Permian, the higher the water cut, or the number of barrels of water we're bringing up with that oil. And so there's going to be a certain amount of takeaway capacity that has to be true. What else do I have to be true? What else has to be true here? Well, there's already a network of pipes in the ground, so there's already a baseline value built into the business. This isn't an asset light company where you're relying on customer contracts for the entire value of the company. There are some physical assets that are underwritten in the balance sheet here. What else do I have? What else has to be true? And we'll get to this probably in the free optionality piece, but the data center build out is coming to Texas. It's coming to these hyperscale campuses in the Permian Basin. The reason for that is in communities nationally, there's been a lot of pushback for bringing data centers into population areas. So you want to go to a place where there are less people and there's abundant gas, energy, and industrial willingness to bring those hyperscale data centers. So have to believe that. And this is really the free option piece. Right now, it's currently priced as an oil midstream company. And we'll get to this valuation piece in a bit, but that's really what you're buying today. What is not priced in is the AI build out. And so we haven't touched on LandBridge or some of the other things. I'm just trying to do a quick overview here, but that optionality is not priced in. So is it currently undervalued by the market? Well, if you're looking at it like an oil midstream company, it is. And as we can see here right now, the market cap is around $3.97 billion. And if we just did a quick run of the EBITDA number, what we have here is really around 392 million of annualized EBITDA. I think management gave guidance it's going to be in the 4 to 430 range, but let's just take the existing number and annualize it. You're paying around 10 enterprise value to EBITDA multiple, which is about the right price for an oil midstream company. So really that optionality for the AI data center cooling power generation is not priced in. Okay, and so you can just do a quick run here, say, hey, what's the multiple necessary for an AI utility company? 15 to 30. Okay, so let's actually evaluate this. I did some Gemini work here as well. And what we can see is, we should expect, let's call it 15, a 15x multiple enterprise value to EBITDA. That's a lot higher than it is today. And when you add in the actual business growth underlying that, you actually have the opportunity for a multiple re-rate. And so just at first glance, when we think about this in conclusion, like, what do I have to believe to be true? I have to believe that this water needs to get taken away. I need to believe that the pipes are going to last a certain amount of time. that the contracts are going to persist. So the pre-loan contracts, you have a physical asset that's underwriting the business. And then there's a free call option with this AI build out. Are they able to monetize the water? Are they able to desalinate it on the back end? Are they able to do what they call beneficial reuse, which is monetize that for a second time? So they might take away the barrel, get paid once. If they can clean it, monetize it a second time to sell it to a data center, there's a lot of optionality there. And is that optionality currently valued by the market? No, it's not. So you have the opportunity for a multiple re-rate, which really protects your downside. And so you don't have to believe a whole lot in this business after just looking at the balance sheet, looking at the free cash flow, and seeing where this business could go. So hope that's helpful. We'll leave it there, and thanks for listening.